Gold jumps to a fresh record high, and so does silver. It's shining even brighter than gold. Australia's GDP growth is on track for 0.6% in the June quarter, and momentum is growing inside Australia's housing market. That's coming up in our 5 Things in 5 Minutes on Tuesday, September the 2nd. And in part 2 of our deep dive interview about a digital renminbi, ANZ's chief economist for Greater China, Raymond Yeung, unveils the missing link, a lack of demand.
Demand for the renminbi outside China doesn't seem to be strong, even though China has been pushing for the renminbi internationalization for almost 15 years.
But first, in 5 and 5 with ANZ, gold prices rose another 0.8% overnight to a fresh record high of $3,556 an ounce US. ANZ commodities strategist Sunny Kamari explains why this shiny metal is the brightest it's ever been.
A combination of factors is keeping the momentum strong as geopolitical tensions are heating up. Investors are questioning the independence of the Federal Reserve. Macroeconomic headwinds are increasing and trade tariffs remain unresolved. So all of this is fueling the rally, and we expect prices to reach towards 3,600 per ounce this year, while there is always an upside risk if things deteriorate from here.
As of 4 a.m. Sydney Melbourne time, the S&P 500 and Nasdaq were closed for the Labor Day holiday. West Texas oil futures rose 1% to $64.67 US a barrel. The US dollar index was flat. The Aussie dollar rose, though, 0.2% to 65.53 US cents, and the Kiwi rose 0.3% to 59 US cents. Number 2. Gold's not the only metal sparkling. Silver futures prices rose another 2.5% overnight to $41.72 an ounce. Silver is actually up 46% this year. That's even more than gold's 36% rise. Here's Sunny again.
So we expect silver's price rally to continue in a rising gold price environment. There has been a real uptick in strategic investment in both gold and silver, but the tactical positions are still lean. So if a speculative demand comes in, we could see even more price action on the upside. So on balance, we believe both gold and silver will continue their upward move until the economic backdrop unexpectedly shift or a peace deal between Ukraine and Russia is reached.
Number 3. From Australia's economy, we received a bunch of components of June quarter GDP figures yesterday, including company profits, wages growth, inventory and sales volumes. ANZ senior economist Adelaide Timbrell says some of the figures were weaker than expected and have reduced the chances that GDP growth for the quarter will be more than 0.6%.
So wages and salary growth of 1% in the quarter. It's a little weaker than we've seen recently. Inventories detracted. That's very much something that flip-flops every quarter. And when we look at sales volumes data by industry, we see that points to a production approach of GDP of around 0.5% quarter-on-quarter growth. All in all, it looks like we'll see GDP growth of 0.6 in Q2, which means that there is some momentum coming into the middle of the year based on that lagged data. It's probably going to be more important for us to understand what happens in the second half of the year as consumers start to rise in confidence and hopefully spending.
Number 4. Adelaide says the latest figures leave the Reserve Bank of Australia on track to cut the cash rate again.
There's nothing in the business indicators so far that would make the Reserve Bank more nervous to do a rate cut this year. It's pretty much in line with our forecast and their forecasts as well. I think what they'll be looking at really closely and is the health of the consumer coming through to the end of the year.
Number 5. Australia's housing market is gathering momentum as those interest rate cuts flow through and as housing supply remains constrained. ANZ economist Maddie Dunk reports prices rose 0.8% in August from July in the capital cities, with prices over the last 6 months rising at an annualised rate of 7.1% across those capital cities. Some are doing even better, with Darwin seeing annualised growth of 19.8% and Perth and Brisbane around 10%. Sydney is up 6.5%. But there is one large laggard, says Maddie.
We're continuing to see that Melbourne's looking a bit softer. So we saw that housing price growth was up just 0.3% in August. That compares to 0.8% for the capital cities. And if you look at that Melbourne housing price number on a 6-month annualized basis is at 5.4%. So sort of behind the rest of the capital cities. And what we're seeing is that, yes, rate cuts have definitely helped and they're boosting demand in the Melbourne housing market, but not to the extent that they're helping places like Sydney, for example. So Melbourne just seems to be trailing behind a bit.
Eddie Dunk there. Now, in part 2 of our deep dive interview with ANZ's Chief Economist for Greater China Raymond Yeung on a digital renminbi, my colleague Alex Tarrant asked if there was actually demand for renminbi as a reserve currency.
Absolutely. Even though China wanted to push for the renminbi as a global reserve currency on the demand side, first of all, there has been a depreciation bias since 2015 exchange rate reform. Obviously, there's also another aspect is called geopolitics or geopolitical concern, and the trade war will also reduce the global appetite, for renminbi as a global reserve currency. Under this backdrop, we may call this deglobalization, so on and so forth. So that the demand for the renminbi outside China doesn't seem to be strong, even though China has been pushing for the renminbi internationalization for almost 15 years or more. But outside Hong Kong, or the cross-border transaction between onshore, offshore, the use of renminbi remains very, very low in trade settlement. There are lots of, financial demands in terms of currency exchange, in terms of portfolio investment because of the bond connect and increasing the holding of the China government bond. But besides that, we have not seen a genuine demand for the renminbi in trade settlement. So that is I think it's a limitation for the renminbi to be a popular global reserve currency in the world.
So what sort of policy measures do you see could be used to increase that demand and also sort of overcome that supply problem you mentioned?
At this stage, all the Chinese government can do is to work on some supply side measures. For example, they continue to sign some currency swap agreement with other central banks so that other countries' central bank will have some liquidity provision from the PBOC using their own currency. So they call it bilateral currency swap agreement in order to reduce China's exposure to the US dollar. Then they are happy to do trade with your currency, for example, New Zealand currency, Australian dollars, they are very happy to do so to avoid the US dollar exposure. This is one thing. The other thing is they could even upgrade this type of currency swap agreement. For example, they are signing this agreement with the HKMA as a standing facilities. Now, of course, Hong Kong is different because it's part of China anyway. Then this will also be applicable to other countries who decide to have these standing facilities in the futures. And the Chinese financial institution or Chinese banks happy to be clearing banks in other countries. And at the same time, this used to be Chinese bank being a clearing bank in other countries. But in some countries that China is actually happy to have foreign banks, or for example, in the US, then a US bank is the clearing bank for the renminbi. So this is perhaps a more flexible approach to develop a network of dollar supplies would be what the Chinese government can do at the moment.
And then I guess this is where the stable coin and eCNY come in as well, is that right?
There has been some talks about whether the stablecoin can help the renminbi internationalization, especially back in June, one of the Chinese onshore newspapers, Security Times, under the People's Daily, wrote about the stablecoin, and the tone or the policy tone of the Chinese government is to develop the stablecoin, or at least to study the use of stablecoin, renminbi stablecoin as soon as possible. So this could be a way to increase the influence of renminbi outside China or in the offshore market, because stablecoin itself is not Chinese currency. It is only a peg or an asset pegged with the Chinese dollar or Chinese yuan. So at least this could also be a way to promote the influence of stablecoin, the influence of the renminbi through stablecoin, and also as a way to tokenize the onshore liability, because stablecoin issuer need to hold Chinese assets, especially the high quality liquid assets like CGB. And if they can do it, now at least that we could see many other some form of privately issued digital currency pegged to the renminbi. Technically, they are not renminbi, they are not eCNY, they are not central bank digital currency, but they are other currency that pegged with the CNY. And this could be a way for China to reduce the dollar exposure as well in the offshore market.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, September the 2nd. Catch you tomorrow with a full preview of Australian GDP figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.